we really felt strongly about being able to pass along to all of you a lot of the content that we discovered at Impact. And so I'm going to tick through a lot of the material today that at least I found interesting. Now, on this first slide, I've summarized the session headings, the session titles. And for this reason, it occurred to me that for most of you advisors who are on this call today, probably going to Schwab's Impact Conference for the purpose of economic analysis from Liz Ann Saunders, who's wonderful, by the way, or anybody else there that might be talking about the economy, or for that matter, going there to hear and learn about portfolio construction or modern portfolio theory, or even an array of what's new in the investment world, probably is not worth your time. At least this is my opinion, because I think all of you have been there, done that. You know all about modern portfolio theory. You know all about the debate of active versus passive management. All of you now are probably 100% up to speed on ETFs and index investing and so forth. And probably there is very little under the sun that could be new to you with respect to the array of investable products out there. And yet it boggles my mind to see probably 100 fund sponsors there, all of whom are competing in the, most of whom are competing in the active management space, and we know that they're up against a very difficult proposition. In other words, increasingly advisors, I think, are realizing that active management is exceedingly difficult. And I know many of you use actively managed funds, and they are certainly appropriate in certain instances. But clearly the pendulum is swinging towards passive, and within passive, smart beta, and that turns out to be one of the chapters that I'm going to address here later today. But back to this slide, here's what really jumped off the page at me. The reason for an advisor to go to the Schwab Impact Conference is mostly, I think, related to practice management, building and managing a successful practice. And furthermore, today, the emphasis is clearly, and you can see this just in the titles of these sessions, on keeping up with the digital revolution. That is such a, that comes across so clearly. So I've underlined just in the titles of these presentations, mobile, websites, social media, paperless, digital revolution, cybersecurity. All of these aspects that in today's world have become so crucial to managing your firm practice. It's not any longer a case of just being able to sit down with a client every quarter or even annually, as I used to do when I was with an RIA early in my career, and calling that sufficient. Evidently, this has become a very crucial aspect to being successful as an advisor today. And interestingly, and Andy, you haven't heard this, but a guy walked up to me at just outside of the Advisor Products booth and unsolicited said to me, you know, Advisor Products does all of this stuff better than anybody else. It's just that they're not a marquee name in the industry. But if you're looking for somebody to help you with mobile, with website, with social media and so forth, this guy told me that in his judgment, Advisor Products is clearly right at the head of the class. Interesting. Isn't that interesting, Andy? And Andy didn't put me up to saying that. I just thought it was fascinating to hear that from an unsolicited source. So again, probably the best reasons to attend the Impact Conference, if I were in your shoes, are the myriad practice management sessions, not so much talking about the economy. And even though the marquee speakers, Ben Bernanke and George W. Bush were fascinating and lots of fun to listen to. In fact, the real content, I think, that was worth going for, and by the way, paying to attend this thing, and it's you know, it's not necessarily cheap, but has to do with this practice management aspect to our business. Okay, now having mentioned Ben Bernanke, let me just take you through the highlights of his presentation. Boy, what a terrific human being, an affable guy. He told some anecdotes that were pretty darn funny. But with respect to the substance of his presentation, I just wrote down some of the bullet points. The first of historic interest I found, and I love financial history, and I bet many of you do too, and I've read as many books as lots of books on it. But the Panic of 1907 was a really was a real sort of seismic event in the annals of U.S. financial history, and it led ultimately to the creation of the Federal Reserve in 1913. So it took 6 years, but what Bernanke said was that the U.S. government, and Congress in particular, was so embarrassed by the fact that J.P. Morgan and other private bankers were the only ones left, were the only lenders of last resort standing, who could, in fact, bail out the financial system, broadly speaking. And so Congress was so embarrassed in the wake of the Panic of '07 that they created the legislation, drafted the legislation, and ultimately created the Federal Reserve in 1913. And it was the Fed's first and original mandate was to be the nation's lender of last resort. The Fed was not created to manage the nation's economy with monetary policy. That was a matter of evolution that came lots later. And Bernanke also said that the Fed clearly didn't do its job in the 1930s. Notwithstanding the fact that they were created specifically to be the lender of last resort, and had they done their job in the 1930s, we wouldn't have had, very likely wouldn't have had the Great Depression, but the Fed failed miserably in the 1930s. And by the way, this is me speaking now, I feel very fortunate to have had Ben Bernanke at the helm. Ben Bernanke, who was the quintessential scholar of financial panics, all the 19th century history of financial panics, and then the Great Depression and the ultimate panic in the 1930s, at the helm of the Fed when what hit the fan in 2008 and 2009. I think we were so fortunate to have Bernanke at the helm because I think, in retrospect, he did all of the right things. And it was interesting to hear him tell about how they were making it up as they went along, which is to say, he said, in the fog of war, the best laid plans go right out the window on the first day. And from that point forward, the TARP and the TALF and all of the other remedies that they ultimately adopted were clearly Bernanke, principally, but all the Fed staffers making it up as they went along. But he knew what to do. He knew what was required, and he knew that the Fed had to have that conviction and had to attack the problem with massive resources, or we were going to go right down the black hole like we did during the Great Depression. So anyway, my own view is Ben Bernanke did a superlative job. He also said that this most recent crisis then left the Federal Reserve with many, many more tools to deal with the liquidity crisis. And I think he was talking about Dodd-Frank. I assume he was talking in many respects about Dodd-Frank, but also within the Federal Reserve themselves, they restructured the Fed significantly, substantially, such that he said that today financial stability as one of the Fed's core missions has regained its stature as an equal partner now with monetary policy as one of the Fed's two key mandates. And I think that's so important. In other words, the whole notion of the Fed as lender of last resort and its primary mission in life being to be the ultimate bulwark against a financial collapse kind of was forgotten. And all of that aspect of the Fed's activities was kind of shuffled into the back room, and it was grossly understaffed, and monitoring of the banking system was really inadequate, and the scenarios like AIG, bailing out AIG, well, what if, well, they hadn't even thought about that stuff. And so his point was, well, now in the wake of that financial crisis that we most recently experienced, then financial stability has regained its stature as an equal partner with monetary policy. So actually, while it's been extraordinarily painful, I guess at least one can conclude that, well, we're in a lot better shape now going forward with respect to a financial crisis than we were prior to this last crisis. He said that the TARP at $700 billion was really controversial at the time, as we all recall, but he said, and it was very unpopular, and he was basically left by himself pitching it to Congress. One of his really funny anecdotes was he said Hank Paulson and he had to go to Congress and address Congress and tell them, first of all, the degree, tell them about the severity of the crisis and what could happen if something weren't done, and then tell them about, well, what do we propose to do? So Paulson gets up and he addresses Congress, and he says we have a proposal for a $700 billion TARP program. And he said, Ben, why don't you explain? So it really fell to Ben Bernanke's shoulders to really, first of all, construct the policy, and secondly, explain it and sell it to Congress. And the congressman said, well, you're on your own in this. We'll go along with it, but basically you're responsible. And Bernanke's point was all the loans were paid back, and taxpayers actually made money on the whole thing. So in retrospect, that's a pretty extraordinary experience. And finally, and most importantly about Bernanke's presentation, I thought, was the question, mostly forward-looking question at this point, because I think that's what a lot of people came to hear, and he didn't really want to get into speculating as to the exit strategy and Yellen's Fed and anything like that. He mostly wanted to talk about the history. But what he did say that I think was so crucial is that quantitative easing did not, and it will not, result in runaway inflation, because today those who still want to criticize the Fed and Ben Bernanke are still super concerned that quantitative easing in the end is going to result in runaway inflation, because after all, it's got to, which takes me to this slide. And if you're a regular listener to these webinars, you will recognize this slide. But Ben Bernanke was the perfect segue for me to go back to this slide that I've been presenting to you now for 3 years. But Bernanke's point, again, summarized in this Wall Street Journal clipping from January of 2013, quoting Bernanke saying that we have all the tools we need to undo our monetary policy stimulus and to take that away before inflation becomes a problem. That's what he reiterated in this week's presentation to all of us. In other words, the problem for all of the critics has been that they never understood it, and evidently there are some people who still don't understand the difference between the monetary base and the money supply. And this is such a crucial distinction. So you've heard me rag on Peter Schiff, this guy on CNBC who keeps talking about this stuff, and it's just nonsense. Or Ron Paul, who keeps saying, well, we will inevitably have runaway inflation. How couldn't we? Because the Fed has printed all of this money. Well, those are really misleading statements, because, again, it belies the fact that those who make those statements do not understand the basics here, and the basics are absolutely critical. The monetary base is what the Fed has exploded. The money supply has only grown in line with nominal GDP, which is essential for there not to be deflation. So unless and until the money supply really starts taking off, we don't worry about inflation. And Ben Bernanke's point, and I would agree with this wholeheartedly, is that It's not going to happen. And Bernanke said flat out, it's not going to happen. And the reason it's not going to happen is twofold. First of all, in order for there to be inflation, money supply has to start surging. And the only way money supply can start surging is if households and businesses start taking down new loans at an accelerating pace. The only way you create M2 in our system is the net positive creation, the net creation of new loans outstanding at a rate that exceeds the recent historic norm. So only unless and until you see the M2 money supply statistic really starting to accelerate and the velocity statistic really starting to accelerate would you get concerned about inflation. And then number two point is, and it's so important that the Fed can clearly practically overnight, should they ever need to undo what they've done with respect to the monetary base. Such an important consideration. Okay, next topic was one of the presentations relating to the whole question of alternatives. And I wanted to address this one because alternatives have clearly come into the spotlight. They are increasingly being accepted by financial advisors because they probably do play or should play a material role in any portfolio. But here's what I found so interesting was the guy that made this presentation was focused on the so-called Yale model. And in the bottom here in this chart, what I've done is to simply focus on the Yale investment return statistic, and this is the 10 years ended June of 2014, even though that's not identified in the slide, of about 11% compound annual. Wow. So notwithstanding the financial collapse, Yale has come through with its investment model with flying colors, and probably substantially better than most, if not any other institutional investor. So that's why I wanted to, first of all, spend any time on this to begin with. And I'm just going to read some of this stuff just so that it's clear that what I'm trying to get across here, so that's clear. When the Yale Endowment Fund posted a negative 24.6% return during the crisis, critics concluded their portfolio diversification strategy and heavy exposure to alternatives was broken. And so the question now looking back is, well, what lessons can we learn from this experience? And these are the lessons, and I think this guy is correct in making these observations. First of all, investors routinely overpay for liquidity because what's clear is that Yale's investment returns and excess returns are in large part function of lack of liquidity. So there's a liquidity trade-off, obviously. And what this guy is saying is that, well, you know, for many investors, maybe some lack of liquidity is okay if the quid pro quo is higher risk-adjusted returns. Interesting. Secondly, diversification is not a waste of time, even if it disappears in a panic. In other words, in the panic, everything went down the drain together. We all know that. There was no way to diversify away the collapse because it happened in every single asset class that I'm aware of except for cash, and you know, and bonds of course held up better, but nonetheless diversification really looked like it didn't do anything for us during the collapse. But again, the point here is that, well, but notwithstanding that, if you have a long enough time frame, and most investors should clearly have a longer time frame than just a couple of years, the span of some kind of crash that we experienced, well then diversification really does make sense, and heavy allocation to equities is essential. And then the final point that I wanted to pass along here is it was so interesting to me to look at this asset allocation, Yale's asset allocation, and you realize that U.S. stocks and bonds hardly play any part in the portfolio at all. It's amazing when you look at this. U.S. stocks and bonds almost not represented. Foreign stocks and bonds here, but the lion's share of this portfolio then is alternatives. In other words, the definition of alternatives being used here is private equity, absolute return strategies, real estate, resources are all in the alternatives bucket. And here, what you see is that, lo and behold, the Yale portfolio has over 80% of its assets in alternatives and a very small piece indeed in equities, and even smaller than that in U.S. equities and fixed income. Pretty amazing. And again, what you're trading away is liquidity, but the point here, I guess, being made is that you trade away liquidity for total return. If you have a long enough time horizon, then it's a very decent trade-off indeed. Okay, that's that presentation. Now I'm moving on to the second presentation that I found interesting. And by the way, just going back, there were lots of presentations on lots of stuff, and a lot of mutual fund companies got to present. But basically, they're all talking up their active strategies, and you can either determine, well, maybe these guys can consistently deliver alpha, but 9 times out of 10 they can't consistently deliver alpha with active management. At least that's my perspective. So I tried to pick out those presentations that really I think do add value in some respect, and are and there is something indeed valuable for me to pass along to you. Now, the second of those presentations, of which is understanding smart beta. What is smart beta? Well, first of all, smart beta or strategic beta, there are a lot of different, several different monikers, but the point here is that we got ETFs, a passively managed but much more liquid vehicle than index mutual funds, and then we got a twist on ETFs called strategic beta, where it's a rules-based application to plain vanilla index ETF. And the point here is today, first of all in this slide, is what you'll see now is that the combination of passively managed, and this includes both mutual funds and ETFs, index funds, plus the addition of strategic beta now adds up to, you add the two together, over about 30% of total mutual funds plus exchange traded products combined. Let me say it again. ETFs, index mutual funds, and strategic beta funds now comprise 30% of total investment products outstanding. So you can see the rate of growth here. Clearly there must be something to these products, or we wouldn't be seeing the consistent and rather rapid growth. But within the so-called passive space, strategic beta is by far and away the fastest growing element of passive strategies. And I'm going to get to why that is here in a second. But these are comparative growth statistics for, first of all, actively managed, and I was surprised to see any growth in active managed, to be honest. And secondly, passively managed, ex strategic beta. So ETFs, broadly speaking, are growing about 11% per year, and the strategic beta sector is growing over 20% a year. Strategic beta. Well, what is strategic beta? Well, first of all, I think probably it's one of 4 buckets within the smart beta universe. It's either equal weighted funds, fundamentally weighted funds, low volatility funds, or minimum variance funds. By the way, I try to figure out what the difference between low vol and minimum variance is, and I wasn't very successful. So maybe some of you on this call understand the difference, but I was having trouble distinguishing the two. But it probably doesn't matter a whole heck of a lot. But the point of this slide is real simple, very simple. With just a quick glance at this slide, what you see is that these smart beta strategies have substantially out-delivered the cap-weighted index with substantially better Sharpe ratios. Wow. It couldn't be any plainer than that. And in fact, the guy from Research Affiliates made this statement. He said, smart beta has been delivering consistently 200 basis points excess return in the efficient markets, meaning, let's say, the U.S., and 600 basis points excess return in less efficient markets. The 200 basis points that he's referring to is captured in this chart. Again, the return of any of these four so-called strategic beta approaches is about 200 basis points, 2 percentage points better than the cap-weighted index, and with substantially better Sharpe ratios. Well, in my mind, it couldn't be any plainer than that. It couldn't be any more obvious than that. I don't know what the less efficient market products might be. I haven't seen any of those. Maybe some of you have, but I'd sure like to know. Because if you can consistently do 600 basis points better than the cap-weighted index in, let's say, emerging markets or something like that, that's a product I'd want to have in the portfolio. Okay, here was a great slide. A blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. And that's a quote from Burton Malkiel in A Random Walk Down Wall Street. Now, so that's called Malkiel's monkey. Now, here is Malkiel's monkey's actual performance. And again, these are simulated returns because these products haven't been around for the 50 years that's captured in the simulation here. But again, it's 100 times simulation comprising 100 different portfolios over this practically 50-year time period. And the monkeys did on average 11.3% return with a substantially better Sharpe ratio than did the S&P 500, the U.S. cap-weighted statistic here. And so that was what Burton Malkiel was getting at. And a lot of people poo-poo the fact, you know, the random walk down Wall Street, the efficient markets, and so forth. But in general terms, he's absolutely correct, and I think as verified by this simulation. And so the reason that they presented this slide is just providing, I think, the academic underpinnings for why a smart beta or strategic beta portfolio might work. The simple equal weighting hypothesis as compared to a cap-weighted approach to investing takes you right to this kind of substantially better risk-adjusted performance, the smart beta versus U.S. cap-weighted portfolio. Now, the caveat, though, and the corollary is that if you're going to use these, be sure you know what you're getting in a strategic beta or smart beta portfolio. Specifically, and again, these actual products here are an attempt to capture the four different buckets within the smart beta universe: equal weighting, fundamental weighting, low vol, and min-var. And so what it's important to understand, I think, is, for example, with the DFA U.S. Core Equity 1 portfolio, you actually have very significant exposure to small and mid caps, small and micro caps, compared to the S&P 500 down here, for example. Or with an equal weighted portfolio, recognize that you have a substantially mid-cap weighted portfolio compared to the S&P 500. So, and the reason for understanding these things is that, you know, there are periods, for example, the late 1990s, when cap weighting was the only game around. So if you had and large cap weighted was shooting the lights out for 4 or 5 years consecutively. So you could end up owning one of these products in a period in which it lags badly, simply because it's really a heavily mid-cap weighted portfolio, and it doesn't resemble the S&P 500 in some crucial aspects. Now here's another one. The RAFI US 1000 portfolio is substantially skewed towards value, as is the low vol portfolio, substantially skewed towards value compared to the S&P 500's 33% weighting in value and underexposed to growth. So anyway, yeah, I think you get the point here. So in other words, I think there's a really strong case to be made for these smart beta, strategic beta products, but if and when you use them, be sure you understand what the downsides could be in certain market environments. It's really important to understand that because they don't resemble the S&P 500 is precisely the point. All right, here just a couple comments on emerging markets, because in some sense I've thought maybe that people have kind of turned away from emerging markets. That was the story 5 years ago, but particularly now that the U.S. has been substantially outperforming rest of world now for a number of years, people have kind of turned away from the emerging markets story. And so I thought that the guy that made this presentation really was worth taking seriously. And I also thought that the update on the emerging markets that he provided was very useful. And so again, the bullet points are here, but I want to just read a couple of these. The emerging market story is far from over. But it's important to understand that all emerging markets are not created equal, not by a long shot. Heterogeneity is crucial to understand. They are not homogeneous. There are lots of lousy emerging markets that I don't think you want exposure to, and that would be a reason, by the way, to own active management in the emerging markets with an emerging markets product. I'd be a huge proponent of active management with respect to emerging markets and not just buying an index that includes a lot of the countries that I don't think you want to have exposure to, not unless they clean up their act or things improve substantially. And then the second point, major point, is China is the central growth story over the next decade, bar none. In other words, China within the emerging markets is the 800-pound gorilla. It will remain so, and the China story is not finito by any stretch of the imagination. And then it's all about compound math, really. Over the next 5 to 10 years of significant excess growth will invert global GDP output and market cap. In other words, if you look today at shares of global output, here in 2013, U.S., Europe, rest of developed worlds are still the vast majority of global economic output, notwithstanding the fact that that share has been cut significantly just over the last 10 years. But that's precisely the point. This trend will continue. There's just no question about it. And so both shares of global GDP and shares of global market cap are going to continue such that the shares will invert over the next decade, and that's a reason to continue, if not increase your exposure to emerging markets over time. And again, this is along the same lines, but an interesting chart. These are shares of global economic growth, and you can see that the lion's share of the share of global economic growth, GDP growth, has been and will continue to come from emerging markets, not the developed markets. And then a related question that I think has been weighing on investors, and the reason that emerging markets haven't been outperforming has to do with some of these concerns. Are they overvalued? Is there an equity bubble? Is there too much leverage in a lot of these countries like there was in the last emerging markets financial crisis? Or is there a huge credit boom that's about to bust? And the answer is, on all four of these scores, no, absolutely not. And in fact, on these four metrics, then emerging markets look very reasonable and healthy, which I think was a really important takeaway. And then finally, the China myths. I thought this was really interesting. Here are the myths. China's growth story is fragile. He says, no, it's not. It's going to have persistence and we're going to, you know, people are saying, well, it's not growing at 11.5% anymore, it's growing at 7.4% China GDP this year. Well, and maybe 7% is the new normal for China, or maybe it gradually degrades to 6%, 5%, and so forth as we look out another decade. And my attitude is, my reaction to that is, well, so what? It's still a great growth story, and it will continue to be long term. China's losing in global competitiveness? No, it's not. China's real estate and slash credit bubble related to real estate will underpin a major crisis. These people say definitely not. Chinese companies lack innovation, no, and Chinese equities are unattractive, structurally weak, and cyclically challenged. No, definitely not the case. And I think this guy is actually absolutely correct on all of these scores. So China is a place to stay invested longer term. Okay, now turning to second to the last presentation that I want to call your attention. So, something with my little circles here got knocked askew. But what I circled here, first of all, the presentation was crafting an income stream from non-correlated assets. Well, the first slide that jumped off the page at me, which I think all of you know, but deserves a reminder, is this slide, plain and simple, makes the case for having a substantial portion of any equity portfolio allocated to a growing dividend strategy. And you can even buy a dividend aristocrat fund or something like that, or there's an ETF called what do you call it? I've forgotten the name of the ETF, but it's been a terrific strategy that's tied to these statistics. Very simply, it's this: a strategy involving consistent growth in dividends results in very substantially superior total return over the long term with lower risk. How could it be any clearer than this? And that's why I say, for my money, I want a dividend growth strategy to represent the core in any equity portfolio. I like superior returns with lower than average standard deviations. Okay, and so we don't have a Sharpe ratio here, but the Sharpe ratio then would be absolutely extraordinary compared to, let's say, a high growth strategy, where in many cases you get no dividend and lots more volatile earnings growth. So I guess I can't, it's a very simple concept, and yet so often overlooked and underemphasized, I think, by advisors. Now, the second aspect to this presentation that I found fascinating has to do with MLPs, Master Limited Partnerships, because within the universe of dividend growth investment vehicles, MLPs, I think, have been underappreciated. Some advisors don't even own MLPs, I think still is the case, which I find mind-boggling. So I wanted to spend the last few minutes of my presentation here today talking about MLPs specifically, and in the context of a major part of a core equity allocation consisting of dividend growth strategy. MLP should play a significant role in the dividend growth portion of any portfolio. Okay, so the first slide here that relates to MLP specifically is this, this shale gas revolution, because most MLPs are tied directly to oil and gas transportation and distribution, not so much the upstream portion, the production, although there are E&P MLPs. The vast majority of MLPs, and I would say the ones where you really want to be invested because of the stability and sustained growth characteristics of the payouts, probably relate to transportation and treating and transportation and distribution. Okay, but that takes you back to the upstream story related to the fracking revolution, and these statistics are what caught my attention. There's 110 years of drilling locations remaining in the Marcellus, 95 years of drilling locations in the Utica, 80 years in the Haynesville, 35 years in the Bakken, and so forth. But so and 80 years remaining drilling locations in the Permian Basin. Okay, so if you think that the shale revolution is a flash in the pan, think again, because these statistics, it seems to me, suggest that this basic picture being presented in this slide is valid, which is to say that we have many, many years and decades ahead of us of continued investment and growing investment in these various basins. And so the MLP story, which consists first of all of attractive payouts coupled with growth in the payouts, I think remains intact for the foreseeable future, and that's extraordinarily important. In other words, if the idea is to invest in a growing dividend stream, then MLPs, it seems to me, will continue to fit the description for the foreseeable future. And so, notwithstanding the fact that in the bottom of this chart you see that the average annual yields here delivered by MLPs have been extraordinary compared to the S&P 500's less than 2% dividend yield, probably those types of yields will persist. At least those types of payouts will persist. The yield, of course, will depend on the price. And it's possible that investors will increasingly appreciate the positive aspects of this investment class and bid the price up. But the point here is that the yields have been extraordinarily attractive compared to the market broadly speaking, and that the total return here has been equally extraordinary, even though the yields have remained well above the S&P 500. So these next couple of slides I've taken from my quarterly, I should say our quarterly. Andy and I collaborate on a quarterly investment review publication. But I just wanted to show you the, oh, I forgot to label this. This is the 5-year total return by asset class. And you can see that MLPs up over 200% over the last 5 years. Total return compared to the S&P 500 total return up over just 100%. And then compared to all of these other asset classes, high yield bonds, for example, REITs, high yield bonds. Again, the context here is how can you diversify an income stream across asset classes where you're getting growth in the payout? And the logical candidates then are leveraged loans, high yield, REITs, and wow, don't forget about MLPs. And in fact, they have been absolutely stellar performers. 5 years, 3 years, 1 year, and then finally, I just generated this chart this morning showing the 10-year total return for MLPs versus total return for the S&P 500. So 1, 3, 5, and 10 years. And over 10 years, you've gotten compound annual 15% compared to compound annual 8% in the S&P 500. Absolutely extraordinary. And again, the corollary in my judgment is it's probably going to persist. I mean, I'm not saying that you get 15% compounded annual going forward, but I would suggest that there's a high likelihood that you'll continue to outperform the S&P 500 in MLPs going forward. And certainly, if you're looking for distributable income, it will remain an asset class that clearly deserves a home in any broadly diversified portfolio. Okay, that's all I have today. I hope you found that interesting. I certainly found the Impact Conference interesting, although again, I concluded that the single biggest value added for any of you on this call probably pertains to practice management and building a practice and all the other ancillary things related to running a business. For example, compliance and cybersecurity, compliance, all of those things that it takes to successfully run a financial advisory practice. And again, rather than going there to listen to somebody talk about the economy or investment strategy, but again, I did find some interesting stuff on investment strategy and the stuff that I tried to highlight here today. I hope you found interesting. With that, Andy, if there are any questions, let's take them.
Yeah, there are, and then I'm going to have some comments at the end. Question from Frank. Doesn't M2, and this was early on in the presentation, doesn't M2 include the monetary base? If so,
No.
Given that
No, and I'm glad, Frank, thanks for asking the question. The monetary base, the best way to think about what it is the commercial banking system's checking account at the Federal Reserve. In other words, it represents the reservoir of cash available to the banking systems with which they could make loans, should they have the demand for those loans. And the point of the slide is to suggest that yes, but for the money supply to grow, you have to have both supply, in other words, as represented by the monetary base, but you also have to have demand for all of that newly available cash. And that's the key distinction that I wanted to get at, and that's the key distinction that I think so many observers on this topic have simply missed. They just don't understand. They think that the Fed has, like, remember the old Ben Bernanke, this phrase came from a 10-year-old Bernanke speech, but he said, it's like helicopters raining cash down on the economy. In other words, if people could just go around and pick up cash, I guess they would go out and spend it. But that's not what's happened with quantitative easing. So again, the monetary base has been exploded by the Fed simply by purchasing from banks their outstanding, the bonds that they have in the bank. It's really an accounting transaction. The Fed has simply exchanged cash for the bonds that they have on their balance sheets, crediting them with cash in their account at the Federal Reserve, and as a result, the banks now have a multiple of what they used to have, 5 times to be specific, available to them with which they could make loans. But unless and until you have demand for those loans on the part of households and businesses, with which they would turn around then and create incremental demand for goods and services, thereby creating more demand for a fixed supply of goods and services, you don't get inflation. So I hope that's clear.
Yeah, by the way, and I should have said this before, but that was a great presentation, and I am so proud to have you speaking here, and working with you is it's just wonderful. And by the way, everybody, we're going to be doing this again. Fritz is going to be coming to the TD Institutional Conference, one way or another. In fact, if you could do me a favor and email your account rep at TD and ask them to invite Fritz to speak at their conference coming up at the end of January. Either way, I'm gonna, Fritz will be there. So, but it'd be great to have him speak there. It would be really good for exposure for Fritz and for me and everybody. So please, if you want to just help us make that happen, that would be great. I love doing organic stuff like that. And here's a great question from Steve. Would you call DFA's approach, Fritz, to generally weighting value and small strategies equivalent or similar to these smart beta strategies?
Read it again, because
Sure.
I think, yeah, go ahead.
So would you say that DFA's approach to generally weighting value and small strategies is equivalent or similar to these smart beta strategies? Are you familiar enough with the DFA strategy to?
A little bit, and I guess my response to that is probably best captured in this slide, because I think that some of the DFA strategies then fit the description of one or more of these smart beta strategies, but not all of the smart beta strategies. And specifically, for example, overweighting value would be clearly consistent with a smart beta strategy based on RAFI. That's fundamental weighting. I think you all know what RAFI is, but RAFI stands for Research Affiliates Fundamentally Weighted Indexes. So it's a way of weighting a portfolio that is derived from fundamental financial metrics company by company, as opposed to using the market cap metric all by itself. So sales and book value, things like that, go into the RAFI weighting. Now that results in a heavy value skew, and so I think the DFA, some of the DFA products probably would look very similar to a RAFI weighting, and similarly a mid-cap or small cap DFA product might look very similar to an equal weight portfolio. That's what I wanted to say. Like the Guggenheim S&P 500 equal weight. By the way, Guggenheim doesn't have any corner on it. There are a lot of S&P 500 equal weight portfolios out there, or products out there now. But an equal weight portfolio then is really a heavily mid-cap skewed portfolio. And that was one of the things point I was making earlier. Don't forget that. So in a market environment in which large cap and mega cap are running up the page like we've seen in the past, this thing's going to lag dramatically. But to answer the question then, a DFA product that would be a heavy emphasis on small and mid cap then would and could look a lot like an equal weighted product.
Yeah, and just great to have a specific, brilliant answer like that. Thank you so much. MLP owners, by the way, Bob chatted in, good point, have to pay tax returns, have to file tax returns in several states. See, that's a good thing to remember.
Hold on, just on that point. And I'm not an MLP expert, and I'm not an ETF expert, but I think there are products like the Illyrian MLP ETF, which obviate that requirement. And so, for example, personally, I'm loaded to the gills with MLPs and have been for a long time, and I have to file. I get all these goofy, these partnership tax filings that I have to do. But I think I probably could not have to do that if I just bought an ETF. And so I think for a lot of all of you then, look for ETFs that own the MLPs, and you may be able to make it really simple.
Have you come across any master limited partnership passive funds or ETFs that you would mention?
The only one I know about is the Illyrian MLP ETF, but I think there are others, so that's the best I can do on that. But they're probably, a number of vehicles, and I say probably because I haven't really studied it that carefully. I've actually really enjoyed owning, and trying to identify individual MLPs where I'm getting some really good growth. I'm trading away some of the yield, but over the long term, I think my total return is going to be superior to just buying the Illyrian MLP ETF, which really mimics a broad-based index.
Robert points out that some mutual funds in the MLP sector avoid this with only a 1099 at year's end.
Yeah, that's what I was trying to say. Thank you. A 1099 is lots better than a K1.
Ticker is AMJ. Just one thing I want to mention, and just because I got scolded. So the gentleman that Fritz referred to earlier that came over and told him how, sung our praises about Advisor Products. And he scolded me, like I said, for not doing a better job of telling people on A4A about what I do and in my marketing work. And the truth is, I don't feel comfortable selling you. So a few of you have left angry comments about my long intros. So I try to rush through them, actually. And I just want to say, so there is one thing, though, that I should mention that I feel obliged to actually tell you, because, I just don't like plugging myself too much here, which I know some of you are going to laugh at. But when you hear that, because I do go on for 8 minutes when we start the webinar. But the truth is that I've seen a lot of advisors who become successful think that they don't need what we're doing, and they think that they can produce their own content and get better results without what we're doing. But I think I owe it to you to just mention that you're probably getting sold, usually by local companies, and what you really need is strategy and content that's more content very often, and customizing your own content, and in a very strategic way. And but many advisors come to think that they're above using a sort of template product, but you're throwing away money, and you're choosing, like I said, a more expensive solution that's probably a lot less cost effective. And I can tell you that this concierge service that we're doing now with Constant Contact is going to improve on what you're doing, no matter how great your own content is, because the strategic coaching and the machine that they have, that they're bringing to bear here, is going to be really powerful, and it's going to improve on what you're doing. And you outsource the whole thing, and it's going to be more cost effective. And then, so when you take the news content that we're providing and overlay the Constant Contact process and fulfillment services, I think you have the most powerful marketing solution in the financial services industry. So I said it. There you go, George. And thank you all for tuning in. We're going to do another one Tuesday. Fritz was, of course, just brilliant here today, and we love him. And please leave favorable comments. I hope I didn't test your patience by telling you about my stuff this time too much, but hopefully it helped some of you, and you will heed what we're saying. And thank you, as always, for attending, and we'll see you next time. Thanks, Fritz.